Welcome to our second episode of our physician series for the 2025 Hidden Money podcast. Kevin and I are excited. Hopefully you've watched our first episode, but if you haven't, you can watch this and go back and check that one out. This one, we're excited to talk about how physicians can save money in taxes, kind of like all of our episodes. But this one, we're going to focus mainly on physicians with multiple income streams and one of our favorites, how physicians can use real estate to save taxes. I love real estate for so many reasons. One main reason is you're not really creating any more. It's a finite resource. And unless it's someplace like Detroit, Michigan, it's always going up in value. But depreciation, it's a magical deduction. Depreciation can allow you to seriously reduce your taxes, and you get to depreciate an asset that's going up in value. When you go buy a vehicle, you get to depreciate it. You get expenses for it if it's used in business, but it's going to go down in value the second you drive it off the lot. When you buy real estate, not only does it offer an option for a potential for an income stream in the future, its fair market value is going to go up and you get to take depreciation. So thanks for joining us. We're going to talk about that in this episode.
Yeah, and there's so many ways to structure real estate and handle real estate when it comes to taxation. So this is going to be just blanket advice. We recommend that you talk to either us or a CPA who knows what they're doing to actually enact this. So what we see a lot now is, in our last episode, we talked about the self-employed physician who we maximize their tax savings at the entity level or their practice level, and now the tax liability has now passed through down to them personally, and so now we have to actually pay our tax. So what can we do now on our 1040 tax return to reduce this income that I have as a physician? And let's say there's multiple strategies. One, if you're married and your spouse, and this we see this a lot, where typically you have a high income earning doctor, then you have a stay-at-home spouse, and that stay-at-home spouse is kind of managing the house, managing the schedules, managing this life, and that spouse can actually be utilized for tax purposes when it comes to real estate.
Be careful how that sounds. You're not using your spouse. You're partnering with your spouse.
There you go.
Yes.
Partnering with your spouse, utilizing their time.
Yes.
Utilizing kind of their ability to use this section of the Internal Revenue Code to reduce the physician's income, the high income earning income. And the way that's done, so you have two types of real estate when we're talking real estate for tax purposes. Now, in reality, there's more than just two types of real estate.
Hundreds.
You have short-term, mid-term, long-term. You have all sorts of different categories in real estate when you're actually in
commercial, yada, yada.
Yeah. But when we're talking taxes, it's two. You got short-term real estate, your Airbnbs and your VRBOs. Those are average lease time of 7 days or less. That's short-term. Then, if it's not short-term, it defaults to long-term. So long-term is going to be your single-family, multifamily properties, could be storage facilities, anything that has lease time or lease agreements that are longer than 7 days on average throughout the year. Those are long-term rentals. Those two have different tax rule sets of how to eliminate W-2 income for the physician or 1099 income or business income from the physician.
Or heck, any other kind of income.
Yes. Or any other income, any sort of W-2 income. But depending on where you go, if you go the short-term rental route or the long-term rental route, will drastically change how we structure and how we tax plan. Now, the overall tax plan, the tax deductions are roughly going to be the same in either. The depreciation, what we can deduct, that doesn't change. What changes is how do I utilize that targeted segment of real estate to reduce my active income.
Absolutely. I do want to just throw out, we're always speaking in generalities. You have to, in tax, speak generally speaking. That's why we say that a lot. At least I say that a lot. There are ways that a 30-day or less property can be treated as a short-term rental, bed and breakfast type places. There's a lot of caveats, but we're speaking about 99% of the tax rules here with real estate. It's a big get. How about I'll talk about the short-term real estate and you talk about the long-term one. So actually, no, let's go into real estate professional first, because without knowing that, you don't understand the amazing beauty of the short-term rental loophole, right? So unless you understand the rules of real estate professional with long-term or commercial real estate, you don't really understand the huge advantage of short-term rental real estate. Like you said, they both have similar tax deductions and availability. But long-term, the only way you or your spouse are able to deduct actual active income from real estate is if y'all qualify, one or the both of you qualify as a real estate professional. What's it take to be a real estate professional?
A real estate professional is going to be 750 hours a year in any qualified real estate activities, such as brokering, buying, selling real estate, fixing it up, repairing it, being a general contractor. If you're working with your hands in real estate, roofers qualify as reps. I can even get a plumber. If you're improving real estate, that is qualified real estate activity time. And you have 750 hours of that, and over half your working time has to be in real estate.
So that's what gets most people.
That's why the doctor is never going to qualify as a rep. You may, let's say you're a hustler of a doctor. You're superhuman. You're able to work 3,000 hours a year in your job as a physician, and you got 750 hours of real estate management. You're just killing it. I don't know how that's even possible. You don't sleep, but let's say you do that. You're still not a rep, even though you hit the 750 hours, because over half your working time was not in real estate. That's why you're never going to hit rep status. But if you're married and your spouse stays at home, they have no other job. They have a job, but no other job for the IRS purposes where they're earning income that goes to that real estate professional
Even
test.
though my wife stays at home raising our kids and doing homeschooling, she works more than I do. The IRS does not consider that a job.
That's right. It's not a job that goes to this
profession.
test. So your spouse could get 750 hours managing the real estate you're buying with the physician's income, could get 750 hours maybe getting a realtor's license and buying and selling real estate on behalf of clients, whatever gets you to that 750 hurdle, and over half their working time is going to be in real estate. So now they're a real estate professional. And now
750 hours, if you do the math, it's just under 14 or just under 15 hours a week.
Yep.
It's doable.
Yeah. And let's think about this. Let's say you're making $1 million as a physician. Your spouse stays at home and y'all buy, let's say, $1 million long-term rental property. The amount of tax savings on $1 million rental property against that $1 million physician income, you're probably going to be saving probably $150 in tax, I would say, bottom line, if you bought $1 million rental. Maybe a little less, maybe a little more, depending on the circumstance. But let's say for this example, it's $150,000 of tax saved. Mm-hmm. That's a $150,000 job for 15 hours a week for your spouse. Think about that. You're the benefit of them pouring 15 hours a week for the year to get rep status and utilize rep status and their material participation in the real estate we're buying with that physician's income is a $150,000 job.
Yeah.
For 15 hours a week. I would do that.
One of our favorite clients, who's also one of my physicians in a specialty I use, she is an amazing doctor. Her husband does a lot of stuff, but he wanted to kind of back down a little bit. There was a discussion they had, and she said, if you can help save us this amount of money in tax by qualifying as a real estate professional, you can keep some of it. He was happy to do it. I think it's been a couple of years since then, and now they're not so happy because running real estate is it's a intense job doing a lot of work, and they wanted to hire full service management companies, but it can be done and it works for y'all. In Kevin's example, let's say you save that $150,000 on $1 million property. You might have only had to pay 15% down. Generally speaking, if it's a commercial real estate, you're buying it as a rental property, you're generally going to have to come up with 20 to 25% down. However, there are rules about buying a second home. And I just want to get into these for a second. We're not finance experts, but we work with a lot of good ones in financing. You can buy second homes and eventually turn them into a rental property. We see it all the time in the short-term rental market, but also in long-term. There's some rules, like the home has to be more than 50 miles away from where your house is. If you buy a second home, you can qualify for 10% down. And we've seen a lot of physicians do this. They buy they put $100,000 down, save $130,000 to $170,000 in taxes, meaning the IRS completely subsidized their down payment. They got some cash to boot, and you own the equity in that property. The bank is financing most of it, but you get 100% of the fair market value increase in it. Now, physicians, you guys work hard. And the way the world's changing and private equity is changing, you are seriously stuck trading your time for money, and time is a very finite resource. But consider this. If you can start to grow a portfolio that can make you money, it can be passive in the future. To be a real estate professional, you got to have some active material participation, but it can be passive in the future. You can turn it into, once you get 10 properties, hire a management company, handle all of them. You can replace a significant portion of your salary and then only work when you want to work, if you want to work. Just imagine the freedom to say, no, I am not taking those weekend shifts. No, I'm not going to be on call but once a year. You could have that freedom without hurting your financial freedom if you do something like this.
Yeah. And that's an amazing kind of weight off your shoulders right there. Like if you can get out of the hamster wheel for a little bit and slowly buying 2 or 3 rental properties a year, and if your spouse can manage those, we're saving taxes. We're exponentially driving our net worth up to where you're going to be feeling in your pocketbook the difference of what you're doing with your cash, and you can have that freedom to say no. The power of no. I'm not working anymore this weekends. On weekends, I'm going to spend time with my kids. No, I am not going to be working when I should be on vacation. No, I am secure enough with my financial future, with the investments we've made, with the tax plan, that I can say no.
If you were a younger physician with family, I'm just going to go back to my father, the physician. He's retired now, living a really good life, actually. His biggest regret in life is not that he didn't put in more time at the clinic or he didn't win more teaching awards. His biggest regret is not spending more time with myself and my sister growing up. You have a chance to change that, but it's going to take doing things differently. Don't follow Einstein's definition of insanity and continue to do the same thing over and over again and expect a different result. Change it up now. Change it up while you still have time. Don't miss out on your kids' ball games.
Yeah.
Don't miss out on their graduation parties. You can change that, but you got to learn to change your facts. And honestly, this is what our podcast is all about at Hidden Money. Change the way you consider tax. It is not something to hurt you. It shouldn't be considered a painful burden every year. It should be considered an amazing power that you can leverage, a tool that you can leverage to grow in your financial freedom. If you don't have kids and you want to keep working 3,000 hours a year, go for it. But continue to grow your financial freedom by leveraging off the tax code.
Yeah, then the last detail I think on the long term, there's 2 major things I want to hit on real quick. One, let's say your stay-at-home spouse gets a real estate license and then brokers and buys, sells some real estate on behalf of clients. They get some income off that. Yeah, we need a tax plan off that. But just becoming a real estate professional does not allow the investments you make with the physician income or wherever the income to buy these rental properties. Just because you have maybe a couple long-term rental properties and your spouse is a realtor does not still make those rental properties you have tax deductible against the doctor's income. There's still more steps. That's the material participation. That real estate professional has to manage those rental properties in order to tax plan with it. So you can't be passive in the real estate as well. On top of rep, you have to do both. You have to be a rep and be materially involved.
But you don't have to materially participate in every property. You got to at least materially participate in one. And there's one more beautiful thing here. So let's say you try this, your spouse is doing it. After 2 years, they're managing your 2 properties and they're just tired. And they're like, I don't want to buy more properties because it's just adding to my time requirements. It's not right. I don't want to keep doing this. Once you're a real estate professional, once you materially participate in one property, not only do you get the deductions from your individually owned properties, now you can invest in like an apartment complex syndication and utilize that rep status, if your tax preparer knows what they're doing, to group it correctly, the material participation grouping for real estate professionals, and get the depreciation from those investments that you are 100% passive in. This is completely legit, completely legal. Get those investments to spin off depreciation to offset your active income. And you can do that over and over again. And just consider the power of compounding. You might only be able to buy one property a year, or maybe one property every 2 years when you start off. But as they start making more money and they got cash flow, you can get to where you buy one a year, then two a year, then three a year. And before 10 years has passed, you've got 20, 25 properties or syndications that are all spinning out. Hopefully most of them, if not all of them, are all spinning off cash flow to you. And once you've gotten that snowball compounding effect, man, you are off to the races. And we've seen physicians do this. One of our good friends and someone we've worked with for a long time, I even helped work on a book, Read the Tax Cure. Check it out on Amazon.com. Dr. Black, he did this, and in about 7 years, got off of that hamster wheel and now only works where he wants to work, how much he wants to work, and he's increased his quality of life a lot and got to spend time with his kids before they all went off to college.
Yep. And Mike, I love that picture you painted. It's very rosy, but I think
hard work.
It takes a lot of hard work, and there's market risks. Once you get to that level, you have a team, and it's expensive. You got a team of accountants, attorneys. You got other people involved. When you're at that level, you have your professional fees are going to go up, but also you got to watch your overhead, make sure you're cash flowing on this. Then you have other risk, market risk, interest rate risks. You might want to refi, pull some cash out. That's tax free, by the way. But can you still cover the debt? The debt on the property on a monthly basis. So we want to make sure we're cash flowing, finding good properties, but hopefully you're also diversifying your properties. You're not all in one neighborhood and then a storm comes in, wipes your whole portfolio out. Hopefully you're kind of spread out amongst different geography areas of the country and all this stuff.
Great point to bring up. I mean, we've seen this happen. We had a lot of physicians getting into apartment complexes in the late 2018, 2019, 2020, 2021, they're doing pretty good. Then interest rates went up and insurance rates went up, and suddenly more than half of these apartment complex syndications were negative cash flow. And that was bad. So it isn't all rosy. You got to be careful. And we say constantly over and over again, don't let your tax tail wag your business dog or your investment dog. Make sure you're underwriting well, make sure you're doing your due diligence. But it can happen. We've seen it happen, and it's a beautiful thing when it happens.
Yeah. So now that we've hit on the long-term rental of how to utilize a spouse to offset your physician income, how to utilize long-term rental properties to offset your physician income, and that was just scratching the surface. There's so many details, how to document it, how to defend it, how to actually get the deductions that you're owed. There's so many things that we haven't covered here. But now let's transition to vacation rentals, because now you can see the work involved to get long-term real estate against physician income. Now let's kind of come with a little softer, easier mandate to get short-term real estate to offset the physician income.
Let's say both spouses are working. I mean, we know a lot of where both spouses are physicians.
Yeah,
they don't
it's
have
very
time
common.
to become
They
a
meet
real
med
estate
school, they
professional.
get hitched, and now they're both working. And
My stepmom was a doctor as well as my dad, and I feel sorry for their kids because the conversations we had at the dinner table, man, was so over my head. They're talking about different drugs and different cancers that my dad found. But anyways, in those cases, or let's say you're similar to me, where my spouse, she works way too hard already, taking care of the kids and doing homeschooling. She doesn't have the time or any interest in being a real estate professional. There's still an option in real estate. It's the short-term rental. It's become known as the short-term rental loophole. I hate the term loophole. It's an incentive, man. It's an incentive purposely put into the tax code so that people will be incentivized to buy property and make it available to improve affordable housing. We have a housing shortage. That's an incentive. But I understand it's generally called now the short-term rental loophole. No one has to be a real estate professional. Not one. Less hour requirements. You need one person needs to do 750 hours to become a real estate professional. If you want to hit the gold standard, the guarantee that the IRS cannot question whether you can take this deduction, you only got to hit 500, and spouses can combine their time, 250 each. And if you're working on the same thing together for an hour, that's an hour for you, an hour for your spouse. You can get that 500 hours. You don't have to have the 500 hours. If you look up in Google IRS material participation, they list 7 different ways to do it. Any one of those count. The second one is you do substantially all the work. That one's nebulous. I have not enjoyed having to defend clients in an audit with that one because there's too many question marks. And what's substantially all? I disagree with the IRS agents on that multiple times. The third one's my second favorite. I call it the bronze standard, and that is 100 hours, at least 100 hours, and more than anyone else. So spouse can put in 50 hours, the other spouse can put in 51 hours. You got 101 hours as long as no individual working on that business outworks you. If you have a management company and they're spending 200 hours a year, or if you're self-managing and your cleaners are spending 200 hours a year, you and your spouse better have 201. And in all honesty, the way it works in an IRS audit, there's a chance the IRS is going to disallow some of your time. So give it a lot more padding than just 1 hour if you can. But then you're a material participant, not a real estate professional. Again, the property you're renting has to average 7 days or less during the year in the lease length. There's a lot of different details can go into that, a lot of questions we could answer, but we don't have time in this episode. If you do that, if you don't use it for personal use according to what the IRS considers personal use, generally it's 14 days or more than 14 days actually, for personal leisure use, where you or you're sending your family or your friends for free to this property for more than 14 days, that would be considered personal use. And then you have a mixed use property, you can't take a net loss. If you are at that property and you go for a month to work on that property, to do market research out for that property, and you're spending the majority of your day at that property, each of those days, that's not personal use. You have those 2 rules, and there's a lot of other caveats and rules that it's too detailed, I think, for this podcast. But if you do that, you buy $1 million property, you get the same benefit as the real estate professional would with $1 million long-term property. So it's beautiful.
Yeah, you can save that. Still, that for our example a little earlier, the $1 million physician buying $1 million long-term rental, the stay-at-home spouse getting rep and saving $150,000. That's that spouse's quote unquote job is $150,000 a year. That's a great job. You could do the same strategy, the $1 million doc buying $1 million vacation rental. Average lease time 7 days or less. Both of you don't need a rep. Both of y'all work together to the same goal to hit those hour requirements. Mike kind of spat out with the material participation. You save the same $150,000. Same tax benefit, just a different classification of real estate, which means different classification of tax law. Generally speaking, also, I've just noticed vacation rentals tend to be more profitable, but they're also more headache because you got tenants coming in and out. Remember, your average lease time is 7 days or less. So you got tenants staying 2 days, 3 days. What am I doing about the wear and tear on the property? What am I doing about security, access? You're having a lot of people coming in there. So you got to make sure you're okay with the amount of work it is to actually get that threshold met.
But you only have to material participate in the year that you're taking the deduction. The IRS says clearly material participation is a year-by-year test. So you can materially participate that first year, get the deduction, and say, I want to do this again on a second property, but I don't have the time to keep self-managing this first property. Fine, turn it over to a full-service management company and just go spend less than 2 weeks the next year. And actually, you could probably spend more. Again, that'd get detailed. Go do it again on another property. We had a physician that did this for 4 properties in 4 years. And by the time they were done, and this started in 2017, by 2021, they were receiving enough income. It replaced 40% of his salary just in 4 years. Again, it's not normally like that, but it worked well. And now They don't manage the properties at all. I want to kill one more myth that I've heard a lot. People say if you have a property manager on your vacation rental, you can't qualify as a material participant. There's a lot of well-known podcasters out here that have said that. That is not technically true. It's not. We have had people under audit who had a management company running their property as long as they qualified as a material participant. If you had 500 hours, they qualified. If they had more than 100 hours, they better be out working that management company, but you can do it. There's a lot of other myths. We should do another episode on myths and short-term rental and real estate. But one thing we need to cover in this episode more, we've talked about real estate, physicians that have multiple income streams. I'm just going to go into one of them, but it's pretty applicable for a lot of things. We have a lot of physicians that invest in the surgery centers that they work at, right? Or that they're affiliated with. Generally in those, they're passive in those surgery centers. Someone else is running the property, running the facilities. They get a K-1 from them. I see this over and over again from other tax preparers. They claim those properties or those K-1s that you're receiving, that cash flow you're getting from the surgery center is not eligible for the qualified business income deduction, the QBI deduction. Bull honky. If your CPA or tax preparer tells you that, they're wrong. They're absolutely wrong unless you're materially participating in that business. And even in a lot of cases, if you are materially participating in the surgery center, you're still eligible for it. And then it's also generally a passive activity. Passive income can be offset by other passive losses. So just to get back full circle with the real estate, let's say you have a surgery center, it's spitting off $500,000 a year in income to you. No one in the family wants to become a real estate professional. You don't want to go the short-term rental route. Go buy a long-term rental. It's a passive activity. Get the depreciation from it and eliminate your surgery center income for 1 year, or mitigate it anyways. There's so many things you can do, Kevin.
Let's say you own your own practice and you own the building you operate out of. That building that you operate out of as a doctor, your family the family practice building, your surgery center that maybe you directly own, but you generate income in that building that you own. Those are probably likely two different LLCs, hopefully for liability purposes. You might have a property company and a operating company. There's ways to make sure that we can cost segregate, accelerate depreciation in the building that you operate out of, because it's necessary as an owner-occupied building for you to generate income over here. There may be ways to not get this as passive, and we could utilize the losses in the rent, not the rental, but the self-rental, to offset your income as a physician too. So
sorry, now that you went there, I have to just add one more. And you can also make sure you're not paying more than market rent, but pay market rent if it's passive to you in your building. You're taking money out of one pocket, putting in the other, but that passive activity, that's passive to you if you're not a real estate professional. The cost segregation, the depreciation can eliminate some of that income. The same income, if you didn't pay that rent, you'd be paying full tax on. There's so many cool things here. I do want to add one more thing. Kevin and I are not licensed attorneys.
One more thing.
We are not licensed attorneys. We're not legally allowed to, much less competent to offer you legal advice. Whenever you're considering liability issues like do you need LLCs for multiple properties, please consult your attorney. And how should we wrap this up?
Yeah, I think that was very. I don't know if you've seen the Pringles commercials where it's like, I bet you just can't eat one. It's like, I feel like we're doing
it's
that.
Hard.
Like one more.
There's so many cool things.
One more. I got one more thing. No, I'm just kidding. One more thing. Thanks for watching. Thanks for listening. Thanks. Give us a like, comment, subscribe. We got one more episode coming next week in our physician series, so stay tuned, and we'll see y'all next week.